Eventual recovery from the current world recession will no doubt depend heavily on the United States, but how likely is the U.S. government's bailout package to succeed? For more on that, I'm joined by Stephen Biggar, Head of Equity Research at Standard & Poor's Rating Agency. Hello to you, Stephen.
Good to be here.
The U.S. stimulus package is over $800 billion. Where's the administration going to get that money?
Well, it certainly comes from the unlimited capability of the U.S. government to print money. But at the end of the day, it's the back of the taxpayers where this is going to fuel deficit spending for the next several years, at least, in order for the financial U.S. to get its financial house in order.
And what are the long and short-term measures in the economic stimulus plan, you think?
Well, there's a lot of criticism of the plan right now. That $800 billion is an awful lot. Clearly, why isn't it done over stages? That too much of it goes towards programs that are actually in out years, going out to 2011, and it's not enough in the very near term, at least, for immediate job creation and stimulation that way. There's a lot in the plan that would provide benefits for the U.S. For unemployment, extension of unemployment benefits, for example, and extension of health care insurance for those that have lost their jobs. So some stimulus in that way, some extension of the tax cuts that are already in place, but far too little, we think, to stimulate immediate job creation, which is what the U.S. needs right now.
Now let's talk about the dollar. What is the midterm outlook for the dollar? I mean, it's still a big. We see big falls in the dollar. What do you think will be in the future?
Well, the dollar strengthened considerably in recent months, and it's about what you would expect in this environment, in a crisis situation, financial crisis, where there is flight to safety in U.S. Treasuries. And also, we think that a lot of the economies that have been in decline throughout the world, some of which are actually worse than the U.S. So on a relative basis, that's why their currencies are being hit hard. So I would look at it, that situation, as not necessarily a strength in the dollar, but weakness in other currencies, particularly European. The pound, the euro, against the dollar have come under considerable pressure.
And the ruble as well.
Absolutely. And that's an oil price situation as well. But the intermediate and longer term for the dollar is probably back the other way for more weakening. As soon as the crisis is over, there will probably be a flight back of capital out of treasuries and into non-U.S. currencies and economies, and that will provide to a weaker dollar going forward. Also, the very large deficit spending, both in terms of current account and budget deficits. The long-term story for the dollar is weak because of those factors.
Now, is spending more? Is it a too simple answer for America's economic problems at the moment?
Well, you would think. The problem is that the Federal Reserve has run out of options in terms of monetary policy with interest rates near zero. So you only have spending at this point to really provide some stimulus. The U.S. consumer generally looks towards confidence is something that if they have a job, if their neighbors have a job, they'll start spending. So you really have to get job confidence back, number one. Stabilize the housing market, which was, after all, the start of the initial crisis and the over-lending that took place. Right. And the negative asset values that are currently happening with housing, as well as the inventory levels. So we have to get inventory levels under control, stabilize house prices, and that in and of itself should give consumers a lot of confidence for the outcome of the outlook for the U.S. economy, and they'll spend a little bit more.
Thank you. Stephen Biggar, Head of the Equity Research at Standard & Poor's. Thank you very much for coming to